Well, good morning. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is July 28th, 2020. We have an audio-only edition for us today, and we thank you for listening. So let's get into the three topics that matter most to what markets are paying attention to with real-time relevant market-related information. Today is a continuation in the news cycle of the first topic we discussed yesterday, which was the horse trading in Washington. The GOP opened up with their $1 trillion coronavirus relief package. It's the party's opening bid in negotiations with Democrats. Essentially less than a few days from now, the unemployment benefits are set to expire. So the fact that we need Congress to work overtime is an understatement, as the economy and those that are in need of that assistance are waiting. And so the U.S. Senate Republicans are intending to unveil their coronavirus package, which they did yesterday. It's normal rhetoric, essentially. The Senate Republicans Monday proposed a $1 trillion aid package and hammer out with the White House. So everyone's on board on one side, but at the end of the day, it really comes down to the other side as well. So the Democrats are basically here to now counter propose. So it's going to be from $1 trillion to $3 trillion, somewhere in the middle. Anything from school benefits to extended unemployment is essentially going to be hammered out. But our ultimate view is there will be additional relief, there will be additional stimulus, there will be additional unemployment. The timing of which is the unknown, meaning we believe it's going to go to the 11th hour, even extra innings, if you will, in terms of Congress actually getting this deal done and agreed upon, signed into law by President Trump later on. So we think we're going to see overtime with this, or extra innings, because I think both sides think that they have sort of the upper hand when it comes to negotiating. I think ultimately, if this wears on further than a few days after there's sort of the deadline that's intended of them working together, that's when we're going to see negative effects continuing to persist. And these negative effects then will weigh on the markets. And we can see the market sell off. As an example, I give this example like a child asking mom and dad for candy, and if they don't get it, it's like a sugar high. They just pull a tantrum. So the market will pull a tantrum if it doesn't get, or what's already priced in, what it anticipates to be more additional stimulus for the U.S. economy. So we will see how this plays out. I think when we see a pullback, there could be potential another opportunity that presents itself on a portfolio management standpoint. So let's see what happens. But ultimately, both sides, it's the normal rhetoric, it's the normal process. They're going to agree to disagree until they have to do something. Hopefully it's not too long. So let's keep an eye on it. Something that's very interesting I want to follow along is that big banks might get a big gift from the stimulus bill that's being drafted by Senate Republicans. Now, again, we don't ever know if it'll actually make it until it actually makes it into law with both sides agree upon it, but lawmakers are expected to include a language that would give the Federal Reserve authority to relax a required surrounding capital levels for the big banks, essentially allowing the banks to load up on riskier assets. And New York Times has reported this. This change would let them increase their holdings of certain kind of financial assets like government bonds without requiring corresponding increase to the capital reserves. This is potentially very big as it relates to the market consolidating. The S&P 500 is in 11 sectors. We've had energy and financials and industrials sort of lag year to date and not keep up with technology and healthcare, as those have been the leaders. And this could be that sort of shot in the arm that sets up, if this legislation is passed and banks have more of a relaxed standard and have riskier assets on their balance sheet, this could set up for banks to rally. And if banks rally, that means that the market overall, S&P 500, those indices that have been lagging, could see a bid from the industrials, energy, as well as financials here. And so the big banks might be able to lift the markets higher high if this legislation sees its way through to making its way into law. See, whatever that becomes. But that's the most important, I think, take-home point here, because that was very related to the market. And it's very related to keeping the S&P sort of either stuck in a trading range or breaking out to seeing earlier highs that we saw even before February for the S&P. We could see that and then break through that if this legislation gets passed for the big banks. So let's keep an eye on that. And I think that's all we have today. I appreciate it. So again, Congress is on watch. We're going to see the deal making play out as it always does. But if big banks win, that could mean higher highs for the markets going forward. So thanks for listening today. Have a great day, and we'll see you next time. Take care.